As the U.S. stock market is currently closed on Sunday, September 21, 2025, we are looking at the final figures from the last trading session. Fubotv Inc., trading under the ticker symbol FUBO on the New York Stock Exchange, closed on Friday, September 19, 2025, at a price of $4.35 per share. This represented a slight downturn for the day of about 0.68%. A fractional move that belies the immense volatility and the high-stakes narrative surrounding this company. The session saw the stock fluctuate between a high of $4.48 and a low of $4.325, trading on a volume of roughly 12.9 million shares. While many retail investors might see that modest daily change and move on, they would be missing the critical undercurrents that are shaping Fubo's destiny. The expectation is that Fubo is a simple bet on the future of television, a cord-cutting play. The reality, however, is a far more complex and perilous drama involving razor-thin margins, colossal content costs, and a now-abandoned gamble on sports betting that continues to haunt its strategic direction. The real story isn't just about subscriber growth, it's about a desperate race for profitability in a market where even giants are struggling to find solid ground. The common belief is that with live sports as its moat, Fubo has a unique edge. But the deeper, more sobering reality is that this very moat is filled with the financial equivalent of alligators, the cripplingly expensive broadcast rights that consume capital and make a profitable quarter an elusive prize. The recent trading patterns of FUBO stock tell a story of nervous energy and speculative fervor. While the stock has seen an impressive gain of over 8% in the last 2 weeks and a staggering 160% rise over the past year, these figures can be misleading. They reflect a rebound from deeply depressed lows rather than a steady, confident march upward. The stock is what traders on platforms like Interactive Brokers or SoFi Invest would classify as high beta, meaning its price swings are far more exaggerated than the broader market. A sell signal was technically issued from a pivot top point on Thursday, September 18th, and the stock's high volatility is a constant factor. For anyone engaging in self-investing, this is not a set-it-and-forget-it name like an Apple stock or a blue-chip holding you might find in a Schwab Intelligent Portfolios account. This is a battleground stock. Institutional ownership sits at around 56%, with major players like Vanguard and BlackRock holding significant stakes. However, a deeper look at the 13F filings reveals a turbulent picture. While some funds like Renaissance Technologies and Two Sigma Investments have dramatically increased their positions, others like D.E. Shaw & Co. have significantly reduced their holdings. This divergence among the so-called smart money indicates a profound disagreement about Fubo's future, a classic sign of a high-risk, high-reward scenario. Retail investors, often using accessible platforms like the Robinhood app, are caught in the middle of this institutional tug-of-war, drawn in by the potential for explosive gains but also exposed to precipitous drops. The volume on Friday was notably lower than in previous sessions, which, combined with the price drop, could be interpreted in multiple ways, either as a consolidation phase before another leg up or as waning conviction from buyers at these levels. It is this ambiguity that fuels the constant debate and makes Fubo a trader's paradise and a long-term investor's headache. To understand the core of Fubo's struggle, one must look at its business model. The company operates a live TV streaming platform with a declared mission to be sports first. This is its key differentiator against giants like Netflix or Disney+, which have historically focused more on on-demand entertainment. The expectation was that by aggregating live sports, Fubo could capture a loyal, high-value subscriber base that cable companies were losing. The reality is that the cost of doing so is astronomical. Licensing deals with leagues like the NFL, NBA, and MLB, not to mention the regional sports networks that hold local game rights, are a massive drain on resources. The company's latest earnings report from early August 2025 for the second quarter provided a perfect illustration of this paradox. On the surface, the numbers looked good. FUBO posted a surprise earnings per share of $0.05, handily beating the analyst expectation of $0.03. Revenue also topped forecasts. This news propelled the stock higher, feeding the bullish narrative. But digging into the financials reveals a more precarious situation. While North American subscriber numbers grew, the company's contribution margin, what's left after paying for content and delivery, remains under immense pressure. They are in a constant, brutal negotiation with content providers, and those providers hold most of the leverage. This is the central tension in FUBO's story. Its primary value proposition is also its greatest financial vulnerability. Many investors looking for investment help or using investing sites to do their research might miss this crucial detail, focusing only on the top-line subscriber growth. For a company to be a viable long-term investment, it cannot perpetually lose money on its core product, a lesson that many tech and media companies have had to learn the hard way. The conversation about FUBO is incomplete without addressing the elephant in the room, its abandoned sports betting venture. For years, the grand expectation was the creation of a seamless, integrated ecosystem where viewers could watch a game and place a wager on the same platform. This synergy was supposed to create a sticky user base and open up a massive new revenue stream, transforming FUBO from a low-margin streaming service into a high-growth gaming media powerhouse. The company even acquired Victory in 2021 to build out its FUBO sportsbook. The reality proved to be a costly and ultimately failed experiment. Citing the challenging macroeconomic environment and the immense cash burn required to compete with behemoths like DraftKings and FanDuel, FUBO announced it was shuttering its sports wagering operations. This strategic retreat, while arguably a prudent financial decision to conserve cash, was also a tacit admission that the grand vision was, at least for now, unattainable. The stock was punished for it, and the company's narrative was shattered. It was forced to pivot back to focusing on its core streaming product, a much harder and less glamorous path to profitability. Today, the ghost of the sportsbook still lingers. It represents a promise unfulfilled and raises questions about management's ability to execute on ambitious, capital-intensive projects. This history is crucial for anyone considering an online investment in the company through their Fidelity brokerage or individual brokerage account. The dream of an integrated platform was the narrative that supported a much higher valuation, and its demise forces investors to reevaluate the company on the much harsher metrics of streaming profitability alone. Looking forward, the path for FUBO is fraught with both significant risks and tantalizing opportunities. The primary risk remains its financial health. The company is not yet consistently profitable, and the specter of cash burn hangs over it. In a high interest rate environment, access to capital is tighter, and any need to raise funds could lead to shareholder dilution. Competition is another immense hurdle. FUBO is not just fighting other vMVPDs like YouTube TV and Hulu Plus Live TV, it is also contending with the media giants themselves. Companies like Disney, with ESPN, Warner Bros. Discovery, and Fox are forming their own sports streaming joint ventures, potentially cutting out aggregators like FUBO or, at the very least, driving up content acquisition costs even further. This is a war fought on multiple fronts, and FUBO is significantly outgunned in terms of financial resources, compared to a titan like NVIDIA stock in its respective industry. However, there are potential catalysts. The company has shown discipline in managing its marketing spend and has been focused on improving its average revenue per user, ARPU, through strategic price increases and advertising improvements. International expansion, particularly through its Molotov acquisition in France, offers a path to diversified growth. The biggest bull case now rests on the idea that FUBO can carve out a niche as the premier service for the most hardcore sports fans and eventually reach a scale where it can achieve positive free cash flow and profitability. Analyst ratings reflect this divided view, with a consensus moderate buy, but with price targets that are widely dispersed, indicating a lack of certainty. Comment below and let me know. Do you believe Fubotv can achieve sustained profitability by 2026, or will rise in content costs and competition prove to be insurmountable hurdles? In summary, the story of Fubotv is a powerful case study in the harsh collision between expectation and reality. The market expectation was for a disruptive force that would seamlessly merge sports streaming and online betting into a next-generation entertainment platform. This was the narrative that captivated investors on SoFi and Robinhood and fueled its volatile stock chart. The reality is a company that has been forced to retreat from that grand vision, now facing the grueling, day-to-day battle for survival in the incredibly competitive and low-margin world of content aggregation. The stock's recent ascent reflects optimism that the company, now leaner and more focused, can finally carve out a profitable path forward. But the risks are undeniable and immense. The very sports content that defines its brand is a financial